Oliver, we've seen a pretty decent run-up in equities markets over the past few days as fears over the coronavirus do appear to ease. But do you have a sense that maybe things are getting a bit ahead of themselves?
Well, it's tough to judge in the short term. I mean, you've had a pretty good amount of things happening in the last few days. You had a good week for President Trump, which markets interpret positively. From an equity perspective, you've got the potential vaccine against the coronavirus, and that seems to be containing itself somewhat. So these are all good things. You've got some pretty good employment numbers coming out as expected, and corporate earnings have been solid. So I don't know that we're necessarily much ahead of themselves. We came into the year expecting a high single-digit return for equities, for U.S. equities, and we maintain that view today.
Maybe I give you this exhibit on the Bloomberg terminal, however. This is a chart that shows investors jumping into junk. Now, is this an example, perhaps, of irrational exuberance?
Yes, it could very well be. Look, like I said, in the short term, things can always correct. Our experience as investors has been that when you see sharp rallies, you see somewhat of a retracement. It's unlikely that it's going to keep on going at 1-2% a day like we've seen over the last 4 days. And in particular, I would point out that there are some chinks in the armor, right? I mean, so overall economic data hasn't been all that great, and we need to see that improve for our case scenario to come true. And also, you've got earnings that still for the fourth quarter are somewhat mixed, so there's a long way to go. But look, again, I think that overall, you're not going to see a recession in 2020 in the U.S. You've got pretty decent earnings growth in part because the comparisons are so much easier than last year. And so that kind of builds the base case, if you include the fact that the Fed's likely to stand pat for, say, somewhere between 6 and 9% equity returns.
Oliver, within the earnings picture that you describe as mixed, where are you finding opportunities?
Well, we like the growth companies and we like compounders. So, if you think about compounders, think about a company that's taking market share away from its competitors, that's growing margins, and that ideally is increasing its dividend or buying back shares or both, so that 3, 4, 5% earnings growth gets compounded as a result of the other things that are happening. Also, we kind of like the win no matter what. If I think about, for example, Adobe, which has successfully transitioned over to a subscription model and is really winning in the cloud, is winning on the enterprise basis. It's a one-stop shop for marketing. That's a great company as a base. And we're staying away or being very careful with value. There's a lot of people pointing to the idea that, this area is underpriced or there's value here. Typically we think that right now in particular there's a reason for that. And let's not forget that it's not quite half. It's closer to 40% of the S&P 500 constituents are in bear market or correction territory.
Why is the bond market more pessimistic, especially when you take a look at the 3-month 10-year, only 7 basis points and inverting earlier this week?
Well, I think that the bond market is correctly looking at the economic data that here in the U.S. and they're saying, hey, look, yes, unemployment continues to be very low, but that's largely driven as a result of demographics and a shrinking working population. Yes, things are okay, but we really like to see a pickup in manufacturing. We'd like to see a pickup in services. We know consumer spending was okay, but it was very mixed. And you saw that in some of the retail reports. So, I think the bond market tends to take a more cautious view than equity investors in general, and is looking at some of that data and just saying, hey, if we don't see improvement soon here, then it could lead to trouble a year down the road.
Oliver, I'm just looking at your asset allocation for a growth portfolio, and you've got overweight cash, about 10%. I'm just wondering why that is. Would you be looking for buying opportunities, or is that a safety measure?
Well, it dampens volatility of the portfolio overall. One of the things that we're always focused on is volatility reduction without necessarily impacting returns. We've been fortunate enough that our analytical team and our CIO has picked some great stocks, so we've made up for that higher cash position. Also, we sold some stuff in Q3, Q4 of last year, and we just haven't found the right entry points yet.
Well, we've just got a few seconds left, Oliver. I just wondered, what's your biggest conviction for 2020?
As a single stock, I don't know that I'm prepared to do that, but I would say certainly technology growth stocks as a sector should do the best out of, say, the 11 sectors of the S&P. So a repeat of 2019 in that sense.